Thursday, July 10th, 10:03 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Topic is going to be on mortgage interest rates, the yields, U.S. Treasuries. Give you some insight. What's going on? First, I'll give you the brief information, and then I'll show you the charts. So, hear me out. Mortgage rates have stayed stubbornly high. That's a fact. You can look at the charts, you can look at the data. Okay, originally it was because of inflation. Inflation had been getting under control up to the past December. That's a fact too. Now, this year, new administration in the White House. Now the signals the mortgage market is taking are based on the size of the federal budget deficit. New president, new Congress, and the bill that passed, big beautiful bill, increases the spending and the deficit. Let's continue on. So there's worries that the budget deficit, instead of shrinking, is going to continue growing. Again, they could continue adding to it. There's more Congress years ahead of us. Well, why does that affect mortgage rates? And directly, other interest rates as well. Yep. Auto loans, mortgage rates, credit cards. Okay, U.S. Treasury Department is one of several federal agencies. We're not talking about the Federal Reserve. We're talking about the U.S. Treasury Department. And we're talking about the Congress and the presidents. Okay, so because the interest rates that people can earn on long-term treasuries and mortgages go directly, they're affected by the 10-year treasury. That's the main U.S. Treasury. I discussed that many times on a video. It's got the best liquidity. As many people take mortgages, some people take the 30, the 20, the 10. Some people hit them off earlier. So let me say this again. The 10-year treasury rates rise as people, investors, get worried about the size of the budget deficit and the amount of debt we have to service the country. We collect tax revenue. That's one way to fund the government. The other way is we sell U.S. treasuries. There's different durations and different interest rates, and those fluctuate when the markets are open. The U.S. Treasury Department markets are open. Yeah. Some people know them as bonds, different durations. There's notes. Also, municipalities and businesses, corporations, and other governments sell bonds. Ours have the best liquidity. The U.S. Treasuries have the best liquidity. Okay. That's the basic information. Let me go to the charts. I also want to mention this too, if you're not situation aware. If Congress and the president get serious about federal spending and the deficit we're producing, because again, it takes both powers, Congress to write the bills, and the president signs the bills. They both approved of this, the majority of them did, to increase the spending, which is increasing the deficit. And rising interest rates and the U.S. Treasury means we pay more on the deficit. We have less revenue go directly to the servicing the main part of the government that we want, not to just be paying interest rates. It's like you got to get a credit card, you carry a balance, you're paying the interest and the balance. Yeah. All right. So direct impact on what happens with mortgage rates. Well, mortgage rates have come down a little with the economy slowing. Yeah. Value of homes are still skyrocketing in many places, and interest rates high. It's pricing out people from the markets. So let me explain this a little bit further now. But real movement in mortgage rates is going to require two things: lower inflation and the federal spending that is out of control. And we have policies with tariffs. That's a lot that needs to happen. And it's not happening year to date. But this is the 30-year yield. Looking at a 5-year chart, each candlestick's a week. And the current candlestick on the top right is not done. You can see the 30-year yield. Yield's been higher. So obviously, the higher it goes up, if you buy them, you earn more income. Hopefully, you stay above inflation. That's a 30-year yield. Let's put this year to date. Year to date, we've been trending up. That's a 30-year yield. Here's the 10-year yield. Again, same thing. Past 10 years. Sorry, the past 5 years is 10-year yield. Let's go to year to date. Yep, still trending up. And the 5-year yield, huge consolidation. You can notice here for the past few years. Year to date, still trending up. And the shorter duration, the 2-year. Again, huge consolidation here. Past several years. Year to date, still trending up. So that means the takeaway here is, again, I'll say that if you buy these savings locked in an interest rate, and the higher these yields go, the more you collect, the more US government and taxpayers are paying to the deficit, just the interest earned, not even paying the hard amount of money down. So those two things I mentioned, the effect of inflation, tariffs, lots going on. You can trade these financial instruments too. That's it. Thank you as always for spending just a little time with me. Thanks for watching the video.